I believe we're going to go a little bit higher, but I do think we're going to see gold have a fairly decent correction. And the last time we saw gold pull back from a recession was 34%. So we could see, gold potentially come back down to this 22, 24 range. I know you don't want to hear that, and probably a lot of other people don't want to hear that, but this is typical price action. This pullback is the same as the 2008, and you need these corrections in order for it to continue the second half or the next wave of the journey to the upside. So it's going to become an awesome opportunity if you don't get caught up in this selling and holding things that are going to drop, like individual stocks, which are a little more volatile. But I'm very bullish on gold. I think we're going to see $5,000, $8,000, dollar gold in the next few years. We just have a hiccup to get through on the way there.
In a recent discussion about the gold market, ChrisVermeulen, a seasoned market analyst, offered deep insights into the current trends shaping gold and silver prices. Vermeulen discussed the incredible gold price run-up from the early 2000s to 2011. He explained how the Fibonacci extension method has helped track this rise and understand the market's pullback. As gold soared, other assets like stocks and real estate were spotlighted. However, gold remained stagnant before suddenly breaking out and surging in the past year and a half. Vermeulen noted that the long-term targets for gold have already been reached, including the 100% measured move of around $2,750. He highlighted that gold has shown similar patterns to previous cycles, such as the 2008 financial crisis and the 2010 and 2011 gold supercycle. Now, he sees gold as potentially nearing its peak in the short term, with a slight upside potential of about 2.5 to 4%. This period is what he describes as the icing on the cake, signaling the final stages before a potential major correction. He pointed out that investors tend to flock to gold in times of economic uncertainty and panic. Gold often performs as a defensive asset as the stock market faces selling pressures. Vermeulen emphasized the importance of timing, warning investors that although gold has rallied, a substantial pullback could come, especially if we face a significant financial reset or recession. For those looking to invest long-term, this could be a great time to load up on gold, with the expectation that gold prices could reach $5,000 to $8,000 in the coming years. As we move closer to major economic tipping points, Vermeulen advised investors to remain cautious. In a final piece of advice, he recommended that gold producers hedge their positions, especially considering the potential volatility in the coming months. We present the latest clips of ChrisVermeulen's video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think we could see gold pull back quite substantially when we have a financial reset, a recession. I think there'll be a much better opportunity to buy more gold, load up with a bunch of pet rocks, as you said. And then after that, that's when gold miners and silver will become, I think, a great opportunity. And the monthly chart, Kai, if I was to just kind of show you what I kind of expect with the price of gold, is I believe we're gonna go a little bit higher, but I do think we're gonna see gold have a fairly decent correction. And the last time we saw gold pull back from a recession was 34%. So we could see, gold potentially come back down to this 22, 24 range. You never know. It could even come right back down to this significant level of 34 like it did last time. I know you don't want to hear that, and probably a lot of other people don't want to hear that, but this is typical price action. This pullback is the same as the 2008, and you need these corrections in order for it to continue the second half or the next wave of the journey to the upside. So I have this question. I did a mentoring session with a whole bunch of traders and investors last week, and they're all like, can I buy gold now? I'm like, you can do whatever you like, but I believe it's like nosebleed pricing. I think there's going to be an abrupt reversal. It's going to become an awesome opportunity if you don't get caught up in this selling and holding things that are going to drop, like individual stocks, which are a little more volatile. But I'm very bullish on gold. I think we're going to see $5,000, $8,000, dollar gold in the next few years. We just have a hiccup to get through on the way there. So silver is getting close to its 100% measured move. So I've got the daily chart, this is the monthly chart here. And I just kind of drew Fibonacci extensions on here so you can get a gauge of where I think silver could go. So we have the 2000 low, the 2020 low, and then it's pulled back and we've hit this 100% measured move this 61% measured move. And now it's working its way up to this $36 resistance area, which if we draw a line across the chart, you can see it's close to some significant highs in the past. It was a significant pivot low here, a couple highs through here. So to me, silver is very close to a very violent topping phase. These three surges this is the monthly chart. This push up and sharp pullback, another push up and another sharp pullback, and now we're on the third one. I call it three surges to a high. I think there's another term for it. It's just what I've always called it, but it's usually a very bearish sign. Usually the market has a huge correction afterwards. So again, I think silver carries a lot of potential downside risk at this point versus gold. Gold holds its value a lot better. Silver, again, for the 2008 financial crisis, I think it pulled back around 65% or 60%. Usually it's going to be at least almost double of what gold is. So silver still has upside, not a lot. It's got maybe $1.50 to the upside. Percentage-wise, it's a lot more than gold, but it is kind of like carrying you're walking through a landmine. In one day, you could give it all back, blink. Silver moves very quickly. So I don't think there's a lot of upside potential in silver, like for the risk. I think there's a lot more downside than there is upside potential here.
As Vermeulen shifted the focus to silver, he discussed its recent lag behind gold. While gold has surged in price, silver has been relatively flat, showing little movement compared to its more glamorous counterpart. Despite this, Vermeulen noted that silver is approaching its 100% measured move, having touched resistance levels at around $36. On the charts, silver's price action has been marked by sharp surges followed by deep pullbacks. This pattern, according to Vermeulen, signals a potential topping phase. He referred to this as the three surges to a high pattern, which often precedes a significant correction. Vermeulen cautioned that while silver still has some upside potential, the risk-reward ratio isn't favorable at this stage, as the downside risk is far greater. Silver, being more volatile than gold, has historically experienced more significant swings. During the 2008 financial crisis, silver's value plunged by more than 60%. Vermeulen highlighted the potential for similar price action soon, with silver facing a more perilous path than gold. Let's get back to the interview.
Using Fibonacci extension, we have this huge run up from the beginning of the last gold supercycle in early 2000s to 2011. And then we can gauge based on this pullback where that should be. And if we carry that price forward, you can see gold has done exactly what we wanted. It came up to the 618 sideways. And during this time where gold traded sideways, this is where all the other assets came to life. Nobody wanted the pet rock at that point. They're all like, get me into stocks, get me into real estate. Everything is a bubble except for gold. And then suddenly out of nowhere in the last year and a half or so, gold just shot up and started to take off, which is to be expected. We talked about this, that the 100% measured move is about 2750, and we've gone up and hit that level. So that long-term perspective has been hit. And now we're in what I call kind of like icing on the cake. This last push is kind of we're getting really close to a major tipping point in the economy, in the equities market. People don't know what to do. They don't trust the banking system. They don't trust currencies. So they start to move to gold. And gold's a pretty small market. It doesn't take much to drive it higher. And this icing on the cake phase is actually what happens just before a pretty major correction. We saw that back in 2010, 2011. We also saw it just before the 2008 financial crisis. Gold had rallied up, hit its measured move, and then suddenly had this shoot up for a couple of months, a few months, just before going into a big correction. So from a long-term perspective, gold has hit its measured moves. As far as I could measure at that point, gold has hit that. Now, if we look at the daily chart where things get a little more intricate here, we can zoom in to find out where the next short-term price target is. And we can do that using a Fibonacci extension on this most recent rally and the pullback. And this shows that we should see gold run to about 3,225. There's another one we could actually draw on a bit longer time frame cycle from this low to here. And that brings us up to roughly $3,260. So there's still some upside potential in gold. Once you've hit the max major chart patterns, all I can really do is kind of say, okay, with a high degree of probability, I can tell you where the next kind of leg range is. So there's like 2.5% to like 4% upside potential for gold for this next run. And so, I mean, it's not huge, but I mean, it's still a nice move. This is definitely a defensive play. Gold is in favor. It is kind of the best play out of everything else in terms of miners or silver, just because gold is that global barometer that when everybody gets nervous and people who have a lot of money, they want to put it into something that has some stability. and gold is that big, slow, what did you call it? It was like the tortoise. And so if something moves slow, it means you can put more money to work. If something moves really fast, like miners or silver, and they're all over the place, you put less money to work because it's risky. And so natural investors who have wealth tend to move into gold around the world when they all get nervous, and the world generally gets nervous around the same time. And then if we zoom into one notch closer, this is the 30-minute chart here on the left-hand side. And more or less, we've got a few different time frames here, but we saw panic selling, this spike here. This is New York Stock Exchange panic selling ratio that I have, that I created. And when we have panic selling in the stock market and everybody's ejecting out of their stocks, this chart below is gold. You can see gold during this time. People started to get nervous. Gold shot up and took off as that defensive play. So you ask Kyle, like, where's the money going if it's coming out of the stock market? Well, it shows here people were dumping stocks and gold was shooting higher. So there's no doubt gold was like the biggest. Gold and bonds were the two that money just said, get me into those things. And so that's what we have right now. And it's a little overbought, and gold's pulling back today as we're talking. And it's because it just had a huge percentage move, big for gold.
ChrisVermeulen provided a comprehensive outlook on both gold and silver markets. While gold has seen substantial gains, Vermeulen believes the market is nearing a critical tipping point with short-term upside potential but the risk of a significant correction soon. He emphasized that the ultimate price target for gold is much higher, possibly reaching $5,000 to $8,000 in the coming years. On the other hand, silver's performance has been more subdued, and its price action raises concerns about a potential correction. Vermeulen pointed out that highly volatile silver poses more significant risks, advising investors to be cautious of sharp fluctuations in its price. For those looking to maximize their investments in precious metals, Vermeulen recommended careful market timing, hedging, and staying informed about broader economic trends. As always, it's crucial to approach these markets with a strategy. That's it for today. Share your thoughts on ChrisVermeulen's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.